Thank you very much. So I've got quite a short 20 minutes to speak today, and I think I just have to start by saying I'm glad that we've already had one win today, which is that you didn't put consultants onto the most annoying list, because I think, speaking to my family, I already know where we've come. So brilliant to start on a nice positive note. Before we get into it, I think I'd just like to talk a little bit about one of my colleagues. So Carol in the US, we've been working together for about 6 years, and when I first met her, she said it's like, we're probably not going to get to know each other that well. Like, she's an incredible industry veteran. She's got decades of knowledge. She's worked in this industry through the ethanol boom, the biodiesel boom, into renewable diesel, and more recently SAF as the market has grown. And so I was pretty cut up. I was looking forward to learning from her. And I have, because every year since then, whenever I've spoken to her about it, she said, well, I'm still going to retire, but maybe next year, maybe the one after. And I'm delighted that we're still having the chance to work with her and learn a lot from her. And that excitement, I think, is something that we see so consistently in the industry, that it feels like every year is more exciting than the one that we've just had. It feels like every time I open the news, there's another 20 news stories, 10 reports, 5 policies, however many facilities and investments. It's incredible to see the momentum. And so in the presentation, I'm going to try and address a couple of those things, looking back at where we've come from, looking across the next decade at what we might expect as we see all of that, and then just a couple of kind of conclusion points at the end. I've only got 20 minutes. I'll try and stay to that, so it will be quite short. We'll have some questions at the end, but always happy to speak afterwards as well. So I think this one captures a lot of that reason that has kept Carol coming to work every day. Like, when we see that excitement, that this isn't a new industry. We've been working on SAF for nearly 2 decades, right from the original certification work that was done, the original kind of trials. We've seen work going into policies to make SAF an eligible fuel. I've got the LCFS as the example in only 2019, so quite recently, but that's echoed in, under the work that ICAO has done on CORSIA, under the ETS, making it eligible in the RTFO, for example, and then the very initial facilities that we've seen starting to produce. But it's only really the last 4 years that we start to see the payoff from a lot of that work. We've started to see 80,000 tons in 2021, but then that more than doubling, to 250,000, then 500,000, 1 million last year, well on track for probably 2 million this year to hit the mandates. So it's a bizarre industry from that perspective, that we have this incredible heritage of work that has gone into building the foundations, and then this incredibly rapid scale up to where we are today. And so looking forwards over the next decade, I'm going to structure the presentation around 3 main areas. So firstly, a little bit on the state of the market. And by that, I really mean supply, demand, and some of the elements within that. Secondly, on geographies. And so it's interesting to see the number of questions there on China, some of that trade flows as well. And I've just got a little bit to speak on from that perspective. And then thirdly, technologies, and we'll see if we have time for that bit. So going straight into it, I think my personal conclusion on the state of the market would be more than required, less than we need. And I'll explain what I mean by that. This is the numbers, the slightly unsexy data that kind of underlies all of the analysis, but this is a lot of work that we do in-house to think about what we have on both the supply side and the demand side. We do these 2 sides completely separately. So on the left, we have the regulatory-driven demand. For this, we have a really detailed analysis that looks at the jet fuel use in every single different country, thinking about cargo, passengers, other consumption. We project that out, thinking about aircraft types, the entrance that we might have into that market, GDP kind of changes, and so forth. And then we do the analysis to kind of say, underneath that, we also have the targets that countries have set, the policies that they've enacted to achieve those targets, mandates, and a whole lot of other elements. And we don't take those at face value. We do a lot of work ourselves to kind of say, what do we think is actually possible to be realized within that, and then apply that to those jet fuel percentages to say, how much SAF do we think we could get? That gives us the regulatory-driven demand. That doesn't include any voluntary offtakes, so any corporate offtakes, work by airlines that they might be taking on-house. So that's just kind of thinking from a regulatory perspective. On the other hand, we then have the supply side. This is also done separately. So for this one, we look at all of the announced facilities. We, again, don't take it on face value. We do a lot of work ourselves to think about, is their commissioning timeline appropriate? Is the technology likely? We cut out a lot. We look at who is the producer, what sort of technology stack they're using, and then we apply a whole lot of factors to kind of bring that back to what we think is a potential supply side. And so this kind of gives us the two halves that can underlie. And it's really when you put these together, you can start to get some quite interesting conclusions. Just for a couple of points as we look down at. So I think the first is, of course, on the demand, we've lumped this all together, but demand isn't the same. There's different types of demand, some demand that's mandated, some demand that's requiring, is more stimulated. So if we think in the US, demand that's both kind of benefiting from some of the tax incentives, but is also selling into a market like an LCFS that can be met by a number of different obligated fuels. And so the first kind of point is that demand isn't all the same. The US does make up quite a significant chunk of demand. We actually do that by looking at the individual states. So we think about the LCFS schemes in California, Oregon, Washington, some of the tax incentives that they have. But I think even so, there's obviously a lot more uncertainty in the US than before. So I think it's important to highlight that quite a large chunk of demand that we see is coming from the US, and there's a question mark on that. Also on China, and I'm going to come back to China in the next section on geography, because that's such an interesting and such a question mark around that kind of the supply and demand side. The supply, I think, the main highlight there is just that emphasis on heifer, that about 80% of the announced supply that we think by 2030 will be coming from heifer. And while there is kind of a growing portion of alcohol to jet, particularly using some of the sugarcane and corn ethanol, it's really that growth and everything else. And I mentioned earlier that when you open the news, you see 20 news stories. Often half of those will be on power to liquids, and I think it's sometimes worth just coming back to the fact that the announced capacity of a lot of those facilities is often quite small. We have really important expectations and a need for them underneath the mandated markets particularly. But in terms of the actual quantities that we expect to get from that, because a lot of the facilities are very small by 2030, it's actually quite small volumes. So there's sometimes a bit of a difference between where we see a lot of the attention and focus and where we actually expect the volume to come from. And it's really heifer is dominating that delivery. So in terms of what this actually means for the market, we can start to put this together. So this is then saying, let's look at the comparison between that supply side and demand side. So if that regulatory demand is reasonably accurate, if that supply is realized, what would that mean for us in the market? And what we've done here is to kind of look at that horizontal lines across it. So saying in 2025, if we look at that level of regulatory demand, that level of potential supply, what do we see there? And then what does that look like in 2028 and 2030? And I think a clear conclusion from us is that if a reasonable number of those facilities are realized, we do start to see a surplus compared to that announced capacity. Again, this doesn't include voluntary demand. So I think a really important conclusion of this is that there's a really significant opportunity for a lot of the voluntary demand to come into the market and potentially address some of that surplus capacity. This is also a product of a lot of the regulation, as for that matter, the entire market is. But in the EU in particular, the way that the mandate is structured has a 2% mandate that started this year. That then stays at 2% for the next years through to 2029. It's only about 2030 it then jumps from 2% to 6%. Of course, when we look at the supply side, facilities are big. They take years to build. They take a while to process and commission. And so you can't just instantaneously bring a large number of facilities on a jump like that. So we see the expectation for a lot of facilities to commission over those next few years. But that means that we then see that facility, that supply coming into the market. That widens that supply surplus that you can see. So you can see by 2028, you end up with quite a large supply surplus. But then by 2030, that kind of snaps close again as we start to see that mandate jump from the 2% to 6%. There are policies in the interim that are kind of sucking up and reducing a little bit of that, so absorbing some of that capacity. So, for example, we see British Columbia have a very small mandate that kind of increases both the volumetric and the CI obligation. There's the Singapore mandate. There's a huge number of other countries like Australia, Brazil, for example, that are also working on policies. So we do start to see those come in. I think for us, there's two kind of really interesting conclusions on this. I think the first is what this means on the supply side and the importance of those long-term offtakes. So it's interesting to see on the survey earlier that demand side being so important, because I think when we look at this picture, we'd absolutely see the data supporting that. And then also what this means for a lot of the production, that it would support potentially some of the production being pushed out to the right, and potentially some of the co-processing, which in our mind forms a bit of a swing producer underneath some of this, to maybe kind of dial down to absorb some of that. This is only going out to 2030. So the next question is, what does the long term look like? And I think Gonzalo on the panel mentioned a really interesting part about the later years actually being the challenge. And we can really clearly see that as well. So when we take that same analysis, looking at the regulatory demand and project it out to 2040, again, kind of thinking about that, all of those factors within it, you get a really, really rapid step up. So it's taken us, almost a decade to get to that 16 million tons that I kind of mentioned by 2030. That's about 4.5% of global jet fuel consumption. But to meet the mandates, to meet the targets that other countries are talking about, and again, this is not taken at face value, we do subtract from those targets to get to what we think is a realistic a volume. We saw that percentage almost doubling in the next 5 years, so going from about 5% to 11% by 2035, then from 11% to over 20% by 2040. So an incredible step up. And of course, underneath that, the aviation fuel and the aviation industry is growing, so there's also increased jet fuel use. So in terms of a volumetric thing, that means going from 16 million tons by 2030 to an additional 26 million tons and then an additional 40 million tons. So it's a really incredible growth. Like if we think back to that first slide I showed, that shows that growth from just 80,000 tons in 2021. We've had incredible growth, but to meet the targets and the obligations and mandates that we're looking at as an industry, it requires a real step up beyond that, and especially in the longer term. And just as a very quick note as well, this is thinking about aviation only. There's, of course, other industries that are looking at the same fuels, the same feedstocks, and maritime, for example, is a super interesting one. We saw the IMO coming out with a policy. It still has to be ratified later this year, but you go into the details of that. It is looking at exactly the same feedstocks and policies, feedstocks and production technologies that we're looking at. But we do not have an exclusive right to a lot of the infrastructure and capital that goes into this. So not only do we have to meet this ramp up, but we also have to do that in the context of growing demand from a number of other sectors. So that's the longer term. Then the next bit I just want to talk very briefly is about some of the geographic part. And when I was preparing this, I thought the China question was probably the most interesting. So thank you for setting that up so nicely earlier in the last session. And for us, there's really 3 data points that support this transition towards a more kind of Asian-focused production. And I'll just run through them. The first is on just the supply side. So if we look at the announced facilities, kind of breaking down that analysis by country, you can see that we have North America kind of leading. That's, of course, supported a lot by the Inflation Reduction Act. As a finite tax credit, that heavily incentivizes producers to bring in capacity as fast as possible. And so we saw kind of a rush into the US, followed by Europe. And the European picture is actually kind of driven equally by regulation, but with slightly different dynamics. Because especially in Europe, a lot of the capacity has been retrofit. There's actually very, very little greenfield capacity that we've seen in Europe. And so that does put a ceiling on what's possible, because of course there's only so many facilities that we can co-process and retrofit. Some really important parts as to whether we co-process at 5% or 30%, for example, but there's that dynamic is really important, that it's driven by both the regulation, but also retrofitting existing infrastructure. Asia is slightly different. Like a lot of the capacity that we've seen being announced and invested in Asia has been greenfield. And also, we also see a lot of a very short cycle going from announcement through to production, much shorter than we see in other parts of the world. And so this kind of creates kind of a question mark as to what sort of trajectory we'd see. In our analysis, we estimate around 4 million tons of supply from the whole of Asia in 2030. And of course, not only this is a given chunk in China, but there's quite significant amounts of that also looking in Japan and Australia and New Zealand and a couple of other countries, Singapore, of course, with the existing facilities there. China alone has a target to achieve 10 million tons of production by 2030. So that's one of the countries in the entire region looking to double that target, that 5 million tons. So there's also, we think we're probably conservative in that supply side estimate. The second is the feedstock question. This came up a little bit earlier, and that there's an intrinsic logic to co-locating facilities next to the feedstock. And if we look at Europe, the majority of the UCO that Europe uses, both for biodiesel and SAF, is imported today. And of that, about 1 million tons comes from China, and then kind of a chunk from Indonesia and Malaysia, and then kind of a much more diversified period from the rest of it. It might actually be slightly higher than this, because there's a little bit of trading that goes on with some of the UCO, for example, coming into the UK, being relabeled and then going into Europe. And so it looks like it's from the UK, but potentially originates from some of the other regions as well. And so the likely kind of chunk is a bit higher. And so a lot of those announced facilities in China, they're not only looking to add in supply into the market, but potentially also to divert some of the feedstock that Europe is currently using at source. So it ends up being kind of a double whammy that you're both potentially reducing some of the potential supply in Europe while also increasing the availability of imports. And this isn't just theoretical. If you look at, to pick one from a long list, Jingshan have been an importer of UCO since 2015. They import about 400,000 tons of UCO every single year. They're looking to use that exact same feedstock to produce a facility. They've invested in it. They expect it to be operational by the end of this year. So it's not just a theory that there's feedstock there. There's an explicit strategy by many of the producers to be using this feedstock for their own production. And then the third is that we do see this from an investment perspective. If you follow the money, there's quite a lot of investment from the obligated parties in Europe investing in facilities and production in China. And to pick three examples that I was looking at, so BP did a $50 million investment in Jiao. That's for a 500,000 ton a year facility. ENI and Petrobras have a facility that they've reached FID in Malaysia. Total and Sinopec doing a 0.23 million ton a year facility in China as well. So there's quite a lot of investment coming from the obligated parties and potentially looking to meet their mandate obligations. And so for us, this raises some really interesting questions around trade flows, about how much we're willing to kind of import. If we take the UK as an example, like the UK road RTFO mandate, we import about 90% of the fuel and feedstock for that policy. So that there is kind of a precedence for quite high import levels for some of this. But then we also see an increasing narrative around some of the domestic production, looking to keep the jobs, the energy security. And of course, that's where some of the policy elements like the STIP that's been working on in the EU, the RCM in the UK, that are potentially looking to kind of address some of these questions. So for us, this is a really big question mark as to what is the willingness for some of those countries to take it, and then also what is the potential for demand. Like at the moment, a lot of the demand signals in Asia are relatively weak. I think it's fair to say that Singapore are in the lead with their kind of flexible mandate, might be the right way to call it. But equally, kind of China talk about having a potentially 15% SAF by 2030. So that as a target, they've talked about 15%. So again, that's kind of a question mark, is this capacity realized? And how much of that demand is also realized in parallel? At the moment, I think our take on it is that a lot of this capacity is export focused. I think, I know we're a little bit short on time, so I'm going to go through the technology just very, very quickly. And for me, this is it's just highlighting that point that you saw earlier about the domination of HEFA, that to a great degree, HEFA has outcompeted other technologies. If we look in many of the markets, like they are often constructed to be a relatively level playing field. And in a relatively level playing field, it's very, very difficult for the more advanced technologies like Fischer-Tropsch MSW or cellulosic ethanol to compete against UCO HEFA, for example. And as a result, we've seen a real focus on a lot of that HEFA capacity. For us, this creates some really interesting implications, because when we look further out, so this is just kind of trying to take some of that requirement, that demand side, there's a real hard limit on how far you can go for the HEFA. There's ways you can push it further, but fundamentally, if we look at something like used cooking oil or tallow, by definition, they are a waste. And that also means that there is a very finite quantity of those, and potentially even more finite if we see some of that being diverted to other industries. So there's a ceiling on what we can do with the waste quantities in HEFA. We can increase that ceiling, for example, by using crops. We can also potentially use more soybean ethanol going into the other markets that are using soy to divert that to SAF. That has sustainability implications. At a global perspective, some regulations are more willing to do that than others. But there is that cap on the HEFA capacity. At the other end of it, we have the PTL wedge, and this is really set by some of the mandated markets. So particularly in the EU and the UK, that has the sub-mandate, and there is potential to kind of lower that potentially if we can bring that power to liquids to be at a cost-appropriate price and scaling the facilities. But almost no matter how you look at it, there's a really big gap that you end up in the middle. There is a kind of finite quantity of HEFA. In the market today, in 2030, we expect it to be about that 80% of capacity. We do think that's viable to achieve with the available feedstock, but it will be difficult for it to go beyond roughly that level. So we start to see kind of plateauing out. And this kind of creates this incredible gap that starts to open up. Power to liquid starts to come in a little bit, but with the plateauing of HEFA, the kind of limited opportunity for power to liquids, at least in kind of the near term, it opens up this gap that needs to be filled. This is where It's really interesting seeing the RCM kind of specifically targeting those second-gen technologies. But for us, there's also some kind of implications that it brings out. So the pressure on feedstocks, for example, the need to make sure that there's really, really good certification of those feedstocks. That's something that's been worked on for decades, but becomes more important as the feedstocks go up in value. The rewards to fraud also go up in value. So making sure that both are being addressed is super important. And then that kind of displacement element. Of course, there's also potentially, this creates more business cases within some of the other ways to meet that heifer. So there are kind of other feedstocks that you can use in heifer, both to expand collection of UCOs, for example. But an example might be pyrolysis oils and some of the work that Bream have been doing to look at creating sort of heifer equivalent feedstocks. They're a little bit more tricky. They need a lot more pre-processing before you can put them into a facility. But potentially kind of methods like that allow you to both scale heifer and then increase the feedstocks to increase that feedstock ceiling. But almost no matter how you look at it, you end up with a wedge, and that's the kind of 0.4 at the end. And that's where we really see the biggest gap in the market is with those second-gen technologies that are generally kind of unsupported or less supported compared to the role that we expect them to meet. So I'll just to conclude, I think the first point for us is just saying that there is incredible growth in this market. When we look at this, we expect about 2 million tons of capacity coming into the market every single year. We were down at Gatwick. We've done some work with them over the years but down with them yesterday at the fuel farm. And it's kind of incredible when you see these volumes in real life. And just to kind of think about what 2 million tons means, if you put that into road tankers and line them up, you create a queue from here to just north of Edinburgh. It's a huge amount of fuel. It's about the same jet fuel consumption that Switzerland use every single year. So it seems small. We talk about 1 or 2% or kind of jet fuel consumption, but this is a really, really significant volume of physical fuel. Like, this is a big industry we're working, and we are growing that capacity incredibly quickly over the next decade. But there are also market challenges. So if we do see a lot of that capacity coming in and potentially the market just not growing that regulatory demand as quickly as the supply comes in, that potentially creates some of the pressure on pricing in the next couple of years. We have seen that process happening already. SAF prices have dropped a lot from 2024 to 2025. As we saw the mandate come in, we've seen that equalize a little bit, although there's still very fragmented pricing underneath the mandate. I think a whole thing in itself there. But for us, this kind of creates the need for regulatory growth to make sure that there is a market for that capacity, and then also growth in the voluntary market to make sure that there are off-takers for that. And to a great degree, I think it means that when we look to the voluntary market, we're not necessarily asking the voluntary market to take on a long-term role, but potentially kind of filling in some of those gaps to make sure that we are commissioning this capacity and we can meet that ramp up kind of up from 2030 to 2035 and 40 that I was showing earlier. So in my mind, the most important time for the voluntary market is today. So it's really, really good to see that there's a session on that later. Thirdly is that element of the trade flows. As we start to see more of a geographic spread in the location of demand and supply, with some countries focusing more on supply, the US, for example, on tax credits and production tax credits specifically that give you the tax credit for the production rather than the consumption. China, for example, who have focused much more on creating the facilities, but currently with relatively weak demand signals. And then other countries kind of looking more on the demand side. So the UK, the EU through the mandates, Singapore as well, and a number of others, British Columbia. And of course, that is to a degree being paired up with policies like the RCM, the STIPs and others. But at the moment, we start to see a little bit of a separation between some of the supply and demand kind of locuses. And for us, that then says, well, if we think there's a separation, that means trade. That means that there's going to be quite significant flows of products between different countries. It means that the certification becomes so important because fuel today, if you're bringing it into Europe, for example, you have to certify it against RED. If you bring it into UK against the RTFO, that is a process that cannot be done in retrospect. You cannot take a batch of fuel and certify it backwards against the thing. So when you make it from the very, very first point of gathering the UCO, you have to be certifying it against the market it's going into. It's sometimes quite difficult to dual certify fuels, and so that does mean that you end up with kind of quite a lot of fragmentation in the market. So that question about fragmentation, about certification, and the portability of some of these fuels is a very, very interesting one. And of course, that's kind of paired with the risk of protectionism, that there is kind of the political question that if we see the EU mandate being met predominantly with imports, what that would mean from a policymaker's perspective if we start to see the question around jobs and energy security kind of resurfacing and becoming pushed up the political agenda. And then I think the last one to just finish with is this kind of longer term perspective that it seems like there is capacity coming in, like we've made a lot of the investments to get that capacity coming in by 2030. But when we look longer term, it's this incredible hockey stick that a lot of the policies are baked in, going from, in the EU, just as an example, from 2% today to 6% by 2030, and then to 20% by 2035. That's almost, more than tripling in just 5 years. And you saw earlier what that means in terms of the volume of kind of going from 15 million tons by 2030, adding an extra 20 million tons in just 5 years, and then just an extra 40 million tons the 5 years after that. So it's, in our mind, the market it's got incredible momentum behind it, but in terms of the longer term goals, there's still quite a big gap there. And for us, that creates a lot of opportunities. It creates opportunities on how we close that gap, how we can push up that heifer ceiling, how we can start to meet some of the innovative technologies and feedstocks that we'll need inside that. And that's me. So just to finish up, that's my email address. I'm very happy to talk about this. I think I probably enjoy it a bit too much. Just to mention as well, so we've had the privilege of working with Sky Energy. They're good friends of ours, and they're an incredibly knowledgeable team. Every year we work with them on a SAF market outlook, and we're actually releasing the next one next year. So there's a little bit more data in this, and anyone is very welcome to come to that session. The QR code gives the address and the sign-up form. So if you'd like to come to the release for that report, then please do search that. Thank you. I think on to the coffee break.